pleasure to introduce us, Sultan, Chief Strategist of the Sultan Interactive Group, and Bob Yostville, Head of Administration at the Oasis Pro Markets. Gentlemen, thank you so much. It's going to be a fascinating panel because when people speak about crypto, legislation, regulation, and all of the risks in this space are very frequently the topic at the center of the conversation. So I would like to give both of you a few minutes to introduce yourself and speak a little bit about your experience in the industry, even prior to what you're doing today, so that your because your background is obviously very, very important to the subsequent discussion we're going to have. Oz, let's start with you, please.
Sure. I have about 25 years experience in the technology and marketing environments. I built Moody's global ratings application generator about 20 years ago. I've done mid-desk consolidation from the Bank One merger, JP Morgan. I built the largest legal management software in the United States for Legion Insurance and Liquidation and Villanova companies. I've worked with tons of family offices over the course of several decades, heavy inside of the video game environment, now going into the metaverse. So I did Xbox's global launch for Kinect. And in the past decade, it's been a lot of heavy data science, and that data science work has led into blockchain, now metaverse development, and we build NFTs. And the interesting thing about NFTs, it's the type of thing where a $250,000 investment can quickly yield about $1.5 million in returns if you have the marketing and things right. But at the same point in time, it's a very volatile market where if these projects don't have roadmaps, you're seeing things crash into walls very quickly with massive devaluations. So there's a lot of advisory that we do. I also sit on the board of Quantum Economics. I advise them on their data science. I'm on the board of the XRSI Foundation, so that's economic advisory in the metaverse and a lot of safety. And I sit on the boards of a number of blockchain companies. A lot of the focus that we're looking at outside of the work that I do inside of development and trying to really kind of educate new financial services companies and other organizations that are coming to the space is in the regulatory environment. So I had written some of the legislation that was put forward in Rhode Island previously, and that was on the floor and had bipartisan support, as well as legislation in Texas. And we are recently just launched NY-BCA.org, where we're looking to soften the BIT license in New York State. So open to a number of discussions around these types of things. But we see the big burgeoning opportunity here is with the OCC basically saying that banks and financial institutions and money transmitters in many ways can custody crypto, and there's some different legislative environments on a state-by-state basis. We've now opened a potentially trillion-dollar industry to really connect itself inside of traditional enterprise banking, as well as the family office and new fund architectures that are out there. And as we look to SPACs and a number of new products that are coming into the market now, there's a tremendous opportunity for the acquisition and roll-up of companies from the metaverse back to blockchain technology, and then also fiscal products that would lead to the ability to custody in either soft or hard wallets cryptocurrency for a wide variety of consumers, as well as financial advisors. And so those are the things that we're trying to work with today to help folks out and to really kind of provide a tremendous amount of education to legislators, which I think is desperately needed.
Thank you so much for that. Bob, would you please introduce yourself?
Sure. Bob Yostville, Head of Administration here at Oasis Pro Markets. I joined this firm in January of last year. Oasis Pro Markets is the first and one of the very few alternative trading systems that have FINRA and SEC approval to trade digital securities for digital cash. digital cash being cryptocurrency. And while we, elect to trade and transact using stable coins, we do have the ability to use ETH and Bitcoin, et cetera, but we choose to use a stable coin to take volatility out of each of the transactions. We're approved to do equity and debt, over the counter, asset-backed securities, SEC registered funds. We can do pretty much everything except for commodities and derivatives and swaps, but we're going down the road right now at the CFTC to get approval for that. Prior to joining Oasis Pro Markets, I was a traditional finance guy. Spent 20 years at Credit Suisse in a variety of roles in capital markets and investment banking, with an emphasis on finance and operations, before I moved over to work at the Bank of America and the Royal Bank of Canada, where I helped manage fixed income trading technology. And that background and experience really opened my eyes to the benefits of digital security tokens, crypto or digital currency, as well as blockchain settlement. Just because of my experience in capital markets, I see in this new world that we're in for issuers of debt, we probably see 40 basis points of savings to an issuer on asset servicing alone. And then on the investor side, especially on the institutional side, we see 80% productivity gains in operations, product control, and compliance, because security tokens have smart contracts built in that take care of all those functions. So it's really a straight through processing model right onto the blockchain. And, it's going to change the capital markets as we know it. So pleasure to be here. Thank you for having me.
Thank you so much. Now, I'm watching the chat, and we're talking about Bitcoins, and especially in light of today's political events. What is your view on that? Let's go again to Oz first, and then Bob will come to you if you don't mind.
Sure.
I think Bitcoin is going to become, sort of your reserve currency in a lot of ways that, everyone from your asset managers to your crypto traders to your day traders start looking at to really kind of hold value. There's a lot of opportunity with alts, but there's a lot of questions about alts, more so because the way that we would traditionally look at a stock is very different than the way that we look at a crypto. Obviously, you're looking at it in terms of the balance sheets and, what have they raised? What is the utilization case? But you're also looking at it in terms of the number of dApps or digital applications that have been deployed on platform. You're looking at it in terms of the developer environment and the developers that have actually picked it up. You're looking at it in terms of GitHub repositories and what's linked and what are the utilization cases for cross-chain and other types of engagement. Honestly, there's different analysis cases from the institutional perspective to what I would call your crypto day traders and folks that are involved in the environment. So a strong reserve currency, also something that potentially has the opportunity to disrupt transactions when the Lightning Network really comes to bear. And that would be the kind of equivalent of, say, a cross in between Swift and high frequency trading capabilities for existing digital assets. To put it in, I don't know exactly the easiest way to simplify that, but we're looking at high-speed transaction tech, and when that comes into play, I think you're going to see more use cases for it. But a lot of it, from the technical side of the environment, it really goes back to the pizza use case. Was, can you buy a pizza with it, and then does it have utility cases to pay for a lot of things? And that functionality is there, and it does it in a very efficacious way with low transaction fees. It also allows for the transmission of large sums of currency with relatively low transmission fees that really underscore the cost efficiencies of T2 and Swift and a variety of other technologies that are out there.
Yeah, I echo a lot of the, yeah, sure. I echo a lot of what Oz just said. With respect to what's happening in the world today, typically in the past where we've seen conflicts that drive up prices of commodities, or or just create destabilized equity markets. We see the flight to safety into U.S. Treasury bonds, right? And I think we're seeing that this week. Bitcoin is an interesting component to all this now, especially in an area where you do have strife and conflict, and where, you know, the wealth of that nation, if it's tied up in something like Bitcoin, it can easily leave. It can depart, or a wallet could be held, you know, instead of being in Eastern Europe, it could be in Nova Scotia. So, you know, that flight to safety doesn't necessarily have to happen if the cryptocurrency wallets are held elsewhere. So I think it's a very interesting, it'll be interesting to see kind of the flows of the cryptos today in Eastern Europe, just to see, you know, kind of what's happening, if you can break it down geographically. But I think it's certainly an interesting time for cryptos. And again, you know, will they ultimately become the place to go to flight to safety for that reason? Well, let's see. You know, I don't want to have another global conflict to find out, I guess. But, you know, it's certainly one of the utilities of a cryptocurrency.
You know, the regulatory landscape for crypto is so huge. We can speak about so many things in terms of legislation and regulation, what companies are facing. It's very interesting that anytime I speak to banks, banks are basically saying, we're just learning, we're trying to figure this out. Anytime you speak to family offices, the vast majority of them would actually say the same. Why do you think, so it's a two-part question, right? In terms of a bank or a family office looking at crypto, and I'm gonna purposefully give you a wide field here, right? Because there's so much involved in this. Where do you think we really are in terms of legislation and regulation, as opposed to the perception of the market participants? Okay, because there's always a gap, right? So we're always lagging a little bit. And secondly, how close are we to opening up our online banking accounts and being able to do through the banks what fintechs offer us? And how close are family offices to going in and assigning another asset class, right? And building that into their portfolio management policies. So what is your view on that? Sorry, it's a long question, I know that, but I'm confident you'll be able to pick at it and pick the parts that you really feel passionate about. Okay,
sure.
So let's go.
Sure. Yeah, sure. So, you know, as I think, as we all know, regulators are laser focused in this space right now. The regulations around cryptocurrency and digital assets and the exchanges out there, you know, the pressure is enormous. And, you know, I think the rule of thumb now is to how we test in terms of what is actually a security, and how we test was something from the 1910s or something like that.
It's 32 or 34, I think.
Well, it's way back in the 1900s. I was actually born in the 1900s, so it makes me feel old, right? But really about orange groves. So, but it's amazing that that test, you know, can still be translated into what's happening now with cryptos. With respect to where we are kind of overall acceptance and adoption, we're certainly seeing more widespread adoption and acceptance. You know, the way I view it here and the way we viewed it at Oasis Pro Market, kind of everything's going to go in stages. You're going to have education, regulation, and implementation is kind of how we're viewing it, where people are learning about cryptocurrencies. There'll be regulation that comes around it. And then I think there'll be a more structured implementation of the cryptocurrencies. Now, with respect to family offices, you know, there are a couple of ways if they want to get exposure to cryptos in a traditional way of, you know, opening up a Coinbase account and establishing a wallet. On the other hand, there are things out there like the Grayscale Trust. There are firms like Fidelity and Goldman who have been pushing to have some sort of a Bitcoin ETF out there. I know the SEC has rejected a couple of those, but I'm sure that there are more in the pipeline. And that would be, you know, just purchasing something, you know, in a more traditional way where you wouldn't need a wallet or need to understand the blockchain or cryptocurrency. You could just benefit from the higher yields. So from that standpoint, I think for family offices, you know, there are a couple of ways in which they could participate, and maybe the dip your toe approach is to, you know, go get into a Grayscale or one of the other ETFs that may come along just to get some exposure that way.
I think I would add to that it comes into three areas. There's compliance, convergence, and trading. And from the compliance perspective, you know, as I mentioned earlier, the OCC has the Office of the Controller of Currency has basically said that banks can custody crypto. But I'll give you a funny case study. There was a mining company I was advising in Texas, and there was a regional bank that came into the Texas Blockchain Association and said, "We're open for business. We're happy to have you." So we took the mining company and we tried to open a bank account with them. And after 2 weeks of going through paperwork, they finally stipulated and said, okay, in addition to these fees and these other fees, we're going to hit you with $500 a month in a compliance fee to figure out how your business works.
Yeah.
And then they were also trying to look at things like having access to our private keys and a variety of other things, where when we started asking them to speak to their chief compliance officer and laid out what they had just asked us, which, you know, that's the keys to the kingdom in terms of crypto. If you have the private keys to anyone's wallet, you can just move their crypto or take their crypto. And when we asked from a securitization standpoint, they didn't know what to do. And so we ended up walking away from the table and ended up going with another bank. In Florida, actually in another state. The challenges first come from the OCC down. Banks are allowed to custody crypto, okay? So, you know, Bob and a number of folks out there have platforms that can be done inside of, but that becomes a algorithm in between soft wallets, which are digitally connected, or hot wallets, you know, that are software based, that are lifetime accessing the internet, where you can trade, where you can do a variety of different things, and hard wallets, which are physical wallets. Like here, I have one sitting here. A hard wallet. Yep. So like a ledger wallet is a hard wallet is a physical wallet. This one has an interface on it. And you can't really see with the background. But what you're talking about is a piece of hardware that you can custody your crypto on, and that has to be put into play with a strategy by which you have some sort of segregation and securitization of that. And that in most cases means we're using safety deposit boxes, we're using safes, we're using some multi-factor authentication methodology to get to these things, or what we're doing is using plain old, you know, Ted over here has the combination, and as a backup, Jane over here has that combination as well, and they're the only two authorized people to access that crypto, and that has to be physically moved back onto network if someone wants to trade it or sell it, and then it has to go to an exchange. The next aspect of this is really kind of the utilization cases that are going into convergence. And so you've got crypto that is now utilizable inside of the NFT ecosystem. And we've seen this with 7-figure and 8-figure sales of NFTs, from everything from loot to CryptoPunks to Bored Apes. And many of these have been at Sotheby's and auction houses that we've known for about 100 years. But at the same point in time, you see things like what happened to Sotheby's last weekend, where there was a $30 million rug pull in our industry, basically, where someone were to pull the money out. Well, in this case, instead of pulling the money out, they just pulled their NFTs, their CryptoPunks, before the sale, and kind of gave Sotheby's the finger and started trolling them online. So you've got this convergence in between those two pieces, and the burgeoning metaverse, which has the potential to be $1 trillion ecosystem, where things can be bought and sold. You know, Robert Scoble, who's a colleague of mine, had talked about maybe about in 2014, that by 2026, most of what would be sold online would be digital assets, and anyone could get into the game of making these. And we're seeing that with NFTs. It's just the aspect of, if you don't have the appropriate marketing, the appropriate vehicles behind that to drive that, you just end up with a dead asset, or art that no one buys. And it was sort of preambled inside of this conversation, well, with the notes of Art Basel, which had led to something called Bit Basel, which happens at the same time. And that's the digital sale of a tremendous amount of NFTs and digital art, some of which is very immersive. And then that goes to the trading aspect of this. People want to buy, sell, and trade these things. And, the ETFs are an easy way to kind of get into this for folks that aren't really accustomed to it. But people who actually want to be trading on a regular basis need to have a platform. I think Oasis is a good start, but there's a bunch of other platforms that are out there that, will do things in a custody manner, in a efficacious fashion that are equivocal to that. But then also, how do you do this? How do you get this culture shift? How do you get these protocols in place? And that's a lot of what we've done, is really kind of consulting with companies to say, all right, let's walk you through how you set this up. But from the family office perspective back to the bank perspective, this is all very new. And there's a lot of folks that don't want to make the mistakes or become the first movers. And that's where I think having a larger scale sort of enterprise trading platform works. But for your smaller family offices that might be looking at 7 to 8 figures under custody, it may make sense to really kind of put protocols in place that are a little bit less costly, but utilize some of the methodologies that I just spoke about and allow for the egress into, many of these commerce spaces while learning about them at the same time.
Yeah, I think what Oz was saying is true. I think the cost associated with these wallets, I think for an individual family office, again, it's daunting. We're actually working with a custodian, Anchorage Digital, that we've signed an agreement with, and we'll be working with them on this to solve this problem. And we've already got a solution in place that will cut the cost down tremendously for individuals. So it's more of a technology solution that had financial benefits to it. But I think you'll see more and more of this as the custodians and the large banks are all faced with tackling this problem. Nothing's insurmountable in this space, and I think we've proved it with our approach with Anchorage.
I have a question, Julia, if I can just interrupt for 1 second or
Sure.
longer. Right. So, I think it's really interesting to look at the architecture of the way NFTs and metaverse, et cetera, are built. And I always wonder whether these protocols are too expensive. Like, I got something that's Ethereum based. It means I have to purchase a whole bunch of Ethereum, which is an expensive product these days. I'm not sure about the quality of the performance either. But I get 5 to 10 calls a week from, crypto guys, ask me for insight, et cetera. And for the first time ever, I got a call last week where somebody said to me, we chose this different protocol because it's faster than Ethereum and a lot cheaper. And any thoughts on that? Do you think that, my opinion is that technology always goes to zero value because people are going to do whatever's cheapest and fastest? Any thoughts on, people moving to cheaper protocols? I mean, Bitcoin, it's digital gold. I'm not going to argue that. But what about
Bob? Do you want to go first, because I've got a couple of minutes on this one because we build this technology.
Yeah, I mean, sure. You're probably more versed at this. I'm not necessarily a tech guy. I mean, we here at Oasis Pro Markets have become blockchain agnostic for that reason alone. And I think as technology evolves and blockchains become more of a utility, I think you will see costs come down over time. That's something that naturally happens, except for
it always happens in tech. Absolutely. Yep.
Yeah, except for your cable TV bill, right? So right. But go ahead, Oz. I'll let you tackle this.
I'm gonna date myself here a little bit. So I want you to think back to the PC wars in the 80s and the early 90s, where people were thinking, is it Mac, is it PC, is it an alternative IBM clone, is it IBM, what is it, right? That's what you're dealing with inside of the crypto ecosystem, but you're dealing with that in terms of a number of currencies, some of which have limitations, some of which don't. when we're talking about Ethereum and Ethereum-based NFTs, a lot of them have been augmented by this new protocol that was called EIP 1559, which was initially supposed to reduce what are called gas fees. So every time I buy an NFT, if I have an NFT that costs me $100 in Ethereum, the gas fees could be anywhere between $30 to $150, depending on what time of day I purchased that, and also what's going on in the network and what commits are there and what other NFT projects are being launched. And with several thousand NFT projects going live on a daily basis, that has a cascading impacts. I'm currently launching 5 different NFT projects. One of which is Soul Shaman, which we were originally going to launch on Solana. The Solana network took a denial of service attack over the Christmas holidays. And then the entire network went down when we were about to deploy the smart contract. So we ended up pulling off of Solana, and we ended up redeploying the entire project on Matic, which is the Polygon network. And if you go to solshaman.com, you can take a look at it. But that goes live. Well, that mint passes went live yesterday. And there's different methodologies of these too. You know, it used to be just buy the NFT. Now we have these things that we're selling ahead of time called mint passes that have different uses and use cases. And they also allow you to purchase the NFTs at a slight discount versus what you have to buy them for. Our mint passes went for 111 Matic, which is about $200. The actual the minting of these, if you don't have the mint pass, are going to be about 177 Matic, which will be somewhere around the $300 range. But there's different protocols for different things. And the Wax protocol, for example, is very, very popular. The first NFT that I was personally released on, which I'm the wizard, number 24, in the blockchain heroes ecosystem, was dropped on the Wax blockchain. And Wax facilitates the sale of a lot of lower cost blockchain products, a lot of lower cost NFTs that are typically inside of the $8 to $250 range. But a lot of these things can appreciate over the course of time, and they can get into the thousands, tens of thousands of dollars of value. When you are thinking about what you want to utilize, and I'm happy to consult with anyone on this, you want to think about, one, is gas an issue? Two, what is the popularity or veracity of the audience you're going after? There's a much bigger Ethereum audience, then there's a Matic audience, then there's a Wax audience, then there's a Solana audience. And then the third thing you have to think about are what are the complexities of the technological environment that you're dealing with. Fourth are regulatory questions that you may have with each one of these platforms. And fifth is a stability and long-term roadmap. When CryptoPunks and the apes, and look, some of the most expensive NFTs out there are these rocks that were dropped in 2014. It is literally a picture of a colored rock that was drawn, but they're worth they're worth several $1 million. Okay, just because there's this novelty to them, and we see this inside of the art market, and we've seen this going back to the 1800s. But those are the things that you kind of have to factor in. I'm happy to talk with anyone afterwards, or if you want to follow up with me, I'm on Sultan and pretty much every social platform. But those are things that you really have to think through. And then if it's protocol speed and the utilization and efficacy of the network and a variety of these other things, those are long, protracted conversations that we can have. It just really depends. What do you want to do? What's your use case? What's your roadmap for this? And is it interesting?
Marty, do we have time for a couple more questions, or should we take questions from the audience? 5 more minutes. Okay. What do you Bob, you mentioned Anchorage Digital custodian. Yep. Who else have you looked at? And it's a question for both of you in terms of enterprise custody solutions. Sure. Who are the top players that you like?
Well, it's interesting you say that. I mean, all the traditional custodians are getting into the space, Fidelity and Bank of New York Mellon that we've spoken to. Now they're really focused on Bitcoin more than digital securities. Anchorage could handle cryptos and digital securities. There's some others out there as well. People like Prime Trust, for example. The issue that needs to be solved next, and that we're working on, is that custodians don't have a standard API structure, and they don't necessarily communicate well with each other. So there is no standardization within the industry. So there are some multi-hub solutions out there that can provide that can standardize the communication between the custodians. People like a GMEX, for example, or Fireblocks that can do that. That's who we're talking to as well. So again, it's a technological challenge that will be overcome as adoption of digital securities and cryptocurrency becomes more widespread.
No, I concur.
Julia. Hey, Bob. So, are you seeing the professionalization of that, tech ranks or the financial ranks in crypto, becoming greater? Because, to me, as you just said, a lot of things don't talk to each other. And a lot of that stuff was like started out of the blue. Whereas guys who come out of Wall Street, that stuff's been getting done forever, and that's where you have to end up, right? So
right.
Talk about that.
Yeah, sure. I think, Jamie Dimon brings this up quite a bit. He says the biggest threat to large banks is fintech. And the reason for that is that large banks are weighed down by legacy infrastructure that is absolutely inflexible. So for them to catch up in this new space and in this new game means they've got to start building infrastructure from the ground up. Having come from large banks, especially on the technology side, a place like Bank of America could spend $500 million in 5 years and not be halfway finished, or even come close to something that we've built here at Oasis Pro Markets. So I think, for the large institutions, it's going to be take a bit of time for them to play catch up here. But they will, and they'll be back in the game at some point. But it's not something that's in the immediate. So that's why you look at places like an Anchorage Digital versus a Fidelity Custody. They're just so far ahead of the game. It's not even funny.
Sorry for interrupting you.
Oh no, it's fine. I mean, I was going to mention Fireblocks backed. Anchorage Digital is decent. You've also got the Fidelity custody solution, and then you've got the Gemini custody solution, and there's a number of other ones that are out there. But it really kind of depends on what you're looking at in terms of your enterprise integration, and then also what are you comfortable with in terms of development, right? Some of these platforms leverage the languages where the developers are more expensive and a little bit rare, especially if you have to go and build an entire ecosystem inside of Rust or something like that. At the same point in time, there's the question of custody, okay, and the utilization of that custody. Are we doing something where we're trying to actively trade, where you would want to look at something like an Oasis? Are we looking at something where we're just custodying and managing, where a Fireblocks or a Backed or a Fidelity might make sense? What are your cost implications inside of this? Are you looking to spend 6 figures, 7 figures, or 8 figures to put this together? What's your time to market? We sat down with 2 crypto banks in Puerto Rico about 22 months ago, and they were trying to do the stuff that DeFi platforms ended up building inside of 6 or 8 months. Right. Is it the most secure thing? No. Does it get hacked on a regular basis? Yes. Is it leaky? Absolutely. Do they have the opportunity to lose millions of dollars? Sure. But was it quick to market? Did it solve a solution? Did it get a massive amount of users in a very short period of time? And did it facilitate a solution that people were looking for? Yes. And that's what the DeFi market has done. And because it's targeting a client base that's predominantly Generation Z and Millennial, a portion of Gen X, but then also focused on your teens now, and they're called Alpha, I believe. You've got a pretty broad base of several 100 million people globally that understand what this is and they can dive into it. But it's also very complicated, especially if we get into yield farming and some of the other things that are out there. And some of these custody solutions don't necessarily account for that or afford for that. And that's really where, if we're talking in between family offices and banks and, what are going to become the new banks of the future, they actually have to solve a portion of this with some of those custody solutions, but there's a lot of custom development that's likely to happen. And the same way that happened in the 90s with your banking systems, it's now happening with your modern digital fintech companies.
Great. We have like 2 minutes. If you guys can wrap up, that'd be great. Parting thoughts?
Bob, did you?
What has me really excited about this space right now is that, we have Bloomberg TV and CNBC on TV in the office here all the time, and they're constantly talking about crypto, NFTs, and digital assets. Mm-hmm. The space is growing tremendously. Digital assets just dropped $2 trillion recently. Mm-hmm. When you have an entire sector dealing with global institutions actually looking to move in, the full potential, hasn't been realized yet. So we're looking at the space to get a whole lot bigger. So, it's just a super exciting time to be here.
Yep, fantastic. Awesome.
Yeah, I think it could crest 200 trillion by the end of the 2020s. And we also have the opportunities for state-based currencies and central bank digital currencies to enter the foray in a manner of fashion where they parallel stable coins. And they also kind of bring this to the mainstream. There's a long road to that, I think, with many Western nations. And especially after looking at how the EU has looked at this. But at the same point in time, we're seeing some really rapid use cases like El Salvador trying to roll out Bitcoin as a parallel to their currency and a major payment system across the nation with the Shiva wallet. So you're going to see some interesting models evolve over the course of the next couple of years. It's a massively exciting time. The derivative products that can be created haven't yet been tapped. The ETFs that can be created haven't been yet tapped. And what family offices are going to be able to do with this in terms of creating lending products and fiscal products for themselves to implement is just yet to be really endeavored upon. And that I find altogether exciting because the regulatory environment is really facilitating that.
Fantastic. Hey, Julia, can you do me a favor and give me the 30-second synopsis of what Agile family offices should be thinking about as we leave this panel?
Oh, what a great question. Agile family office would always think about new products to add, new investment products, obviously, right? New investment classes to seamlessly add, to risk manage along the side of other assets for comprehensive risk management. And of course, tremendous issue, cybersecurity, right? Because in light of OpenSea hack recently and so many other cyber events, you have to be 100% secure as you're playing in these markets. You have to understand your risks. You have to understand your governance structure around it. But this is most definitely a very fun new product to plug into any lineup. And of course, in 5 to 10 years, everybody's going to have that. The question is how secure and how intelligently is it going to be woven into the rest of the infrastructure?